So are you all there? Welcome.
You are in mute.
I am in mute. Now I am not there in mute, I think.
Yes, it's audible.
Yeah. ठीक है. No problem. Good. So what we were discussing, that we need to discuss one or two problems to get 100% clarity on what I am saying. Okay? So one example, relating to the example, some technical words are there that I will discuss along with the example only. Otherwise it is difficult to understand those technical terms. On 1st January 2011, B purchased a factory building with a useful economic life of 50 years. This is the example which I give, 1,50,000 computer and I gave 5,000 shares. This is that example, normal. Not relevant for exam, just that. The building had a fair value 10 million. The company purchased the building for 10 million. The value of the building 10 million. And the building will be used in the business for 50 years. The consideration be transferred for the purchase was 1 million of its own $1 equity shares, which had a fair value of 12 million. For this building, company has not paid cash. The company has given shares, and the company has given 1 million shares. Like I said, I gave my 5,000 shares. The face value, par value was 10 rupees. Their face value is $1. 1 million shares of $1. But the fair value is 12 million. The fair value, maybe their shares are listed in the stock exchange. Or maybe, as I said, if you do my assets minus liability and you divide by number of shares, then maybe my value of the shares will be coming 500 per share. So that way they are saying that $1 million, 1 million shares value is 12 million. Against the building, we have given shares 1 million. The fair value of shares is 12 million. Explain how this transaction should be accounted for the year ended 31st December 2011. So it is not relating to employee, ESOP and all that. It's pure you are purchasing an asset, and for the asset you are making payment in the form of shares. Now, when the value of the building is 10 million, then why we will give the shares of 12 million? When the value of assets is 10 million, then why we will be giving the shares of $12 million? Not at all. If I am purchasing a computer for 1,50,000, why I will pay greater than 150? So whenever you are purchasing an assets and you are giving the shares, then the share value is equal to assets value. The share value doesn't matter. Whatever the assets value, that is treated as the share value. So this 12 million is given as a googly. No use. Because by giving shares, you are getting the assets of 10 million. By giving shares, we are not getting 12 million worth of assets. We are getting value of 10 million assets. So we will say that the assets are given, the assets are taken by giving shares of 10 million value, not 12 million. This is a googly information in the question. No use. Because if you say that your value of shares is 12 million, then why you will not be getting the assets of a 12 million? You are ready to give shares of 12 million for 10 million assets. That means the shares value is also 10 million. So if I will not go into journal entry like Sujit or anything, no journal. Straight simple concept. I am saying that the 10 million is the assets value. I got the assets. So in the balance sheet, property, plant and equipment, 10 million added. And now for that shares are given 1 million share, $1 each. Face value is 1 into 1, 1. And 10 minus 1. 10 million assets, 1 million is the share value. So balance 9 million is share premium. So when I will prepare a statement of changes in equity, there in the share capital column, I will add 1 million shares into $1, and the balance 9 million I will add in share premium, securities premium. So in the liability side, share capital will increase by 1 million, share premium will increase by 9 million, that is total 10 million. And in the asset side, the property, plant and equipment is increasing by 10 million, balancing. The assets and liability are equal. For every transaction being recorded in the books, the assets minus liability equals to equity. Here asset is going up, equity is going up. Asset is going up by 10 million, equity is going up by 10 million. Under equity, share capital, retained earning reserves, share premium, everything is there. So the left hand side is going up by 10 million, the right hand side is going up by 10 million. Every transaction should be fulfilling the assets liability equal. If somebody will say journal entry, in the journal entry, debit credit concept is whenever you have increase in the assets, then the policy in accounting, not only IFRS, Indian, any accounting, whenever there is increase in asset, it is one aspect, debit aspect. Whenever there is increase in liability, it is another aspect, credit aspect. Increase in asset, debit. Decrease in liability, debit. Decrease in asset, credit. Increase in liability, credit. That's the debit credit concept. In place of assets equals to liability and capital, we can say debit credit. For debit, there is increase in assets or decrease in liability. For credit, there is decrease in assets or increase in liability. In this transaction, asset is increasing by 10 million. So debit. Liability, equity or liability are increasing by 10 million. So credit. So if somebody will say journal entry, then journal entry will be factory building debit 10 million. Equity credit, share capital credit 1 million. Share premium credit 9 million. This 12 million does not have any meaning. Because if the value of your shares is 12 million, then why you are getting the assets of 10 million? That means the share value is also 10 million. So 10 million is debit property, plant and equipment. Share capital is 1 million. Credit, share premium, other component of equity 9 million. When we prepare balance sheet, the asset side, property, plant and equipment increasing by 10 million. The liability side under equity, share capital and share premium increasing by 1 million and 9 million. Basically, these two will be coming in the statement of changes in equity, and then the final figure of a statement of changes in equity will be coming in the balance sheet. It is written here, this is an equity settled share based payment with a supplier of factory building. The transaction is valued at the fair value 10 million. The transaction is accounted for in full at the grant date. When we purchase the building, we have given the shares. The building 10 million will be depreciated in 50 years because the life of the building is 50 years. So every year depreciation will be 10 million divided by 50.2 million. Relating to depreciation for the time being, in short, because when we will study non-current assets, then we will study depreciation, non-current assets, everything. But for the time being, depreciation is also an expense. And depreciation is decrease in the assets value. Because of the depreciation, the assets value gone down. So I said increase in the asset debit, decrease in asset credit. So decrease in asset credited. The assets credited and expense debited. One more concept in accounting we can say, all expenditure and losses debit. All incomes and gains credit. All expenditure and losses debit. All incomes and gains credit. So depreciation is debited because expense. Asset is credited because decrease in asset. Increase in asset debit, decrease in asset credit. So journal entries are also written, but forget journal entry. Depreciation will be coming as an expense in PL account. In which heading? If the factory building is used obviously in the manufacturing activity under cost of sale. If the building is used for any other purpose under selling or admin, so depreciation will be included under cost of sale or admin or selling. And then in the asset side, the property, plant and equipment will be reducing by the depreciation amount. So in the liability side, retained earning is lower because profit is lower. And in the asset side, asset value is lower because depreciation is reducing the balance sheet tally, both gone down, balancing. Whether you say debit credit, which is old concept of accounting, whether you say accounting equation within modern accounting. Modern means not today. That modern is also 10-15 years old. So somebody can understand accounting in the form of equation, balancing, assets equals to liability, modern concept of accounting. Or somebody can understand accounting in the form of debit, credit, golden rules of journals. Debit all expenditure and losses, debit increase in assets, credit all incomes and gains, credit increase in liability. It's upon us the way we want to understand. I generally always want to follow the modern accounting concept, not the old accounting concept where we need to mug up. The modern accounting concept says assets equals to liability. So if there is a plus in assets, there has to be a plus in liability. Or has to be some deduction in some other assets. Then only the balancing will be done. That is called modern accounting concepts. Both are basics, but that accounting equation is called modern accounting concept. For that reason, I generally don't prefer debit credit, where I need to help you to mug up the things. No mugging up. The basic concept of accounting, balancing. Assets equals to liability. That concept. Now the example which I need to discuss with so many things. It will take some time, half an hour to discuss this example. Once we understand, we can solve it in 3 minutes. No problem. But for the time being, understanding technicality, explaining all the things again, some reading some theory stuff, why they are written and all that, it will take some time. Give me some time and then you all can ask whatever doubts you have. So N offered a share-based payment scheme to its staff. Now, share-based payment to employees, staff. On 1st January 2015, it granted 300 employees 1,000 share options each. Share options means shares. 300 employee. Every employee will be given 1,000 shares each. So it is 300 into 1,000, 3 lakh shares. Never the employee are given 1 share per employee. That can be, but never it happens. Every employee is given a certain number of shares. So 300 employee. Every employee will be given 1,000 shares. 300 into 1,000, 3 lakh shares. This the company is announcing, this the company is entering into a contract on 1st January. But the employee need to fulfill certain conditions. What are those conditions written? The option becomes exercisable. The employee will be getting shares if they are still employed on 31st December 2017. So January 15 to December 15, 1 year. January 16 to December 16, 2nd year. January 17 to December 17, 3rd year. When the employee will work in the company, these 300 employees for 3 years, then at the end of 3 years, they will be eligible for 1,000 shares per employee. So those who will leave the company in 3 years, they will not get any shares. They need to work in the company, in the same organization for 3 years. Then they will be getting 1,000 share per employee. The fair value of the share option at 1st January 2015 was $10 per option. What is the meaning of this language? Very essential to understand. Otherwise, every time when you do the problem, this language is written, you feel discomfort. So for comfortableness, understand. I gave the example that Reliance company share is say 2,500. And in 3 years, it will become 4,000. I am going to give employee at 40%. So 4,000 into 40% at 1,600. Employee will be giving 1,600, we will be giving them Reliance shares after 3 years. But the value of share after 3 years is going to be 4,000. So what is the loss to the company? 2,400 per share. because 4,000 rupees share we are going to give to the employee at 1,600 rupees. So the loss to the company will be 2,400 per share. That is called fair value of the option. This is the loss per share to the company. That means they are never giving you information. After 3 years, what is going to be the share value? After 3 years, at what price we are going to give them the shares? So, and 3 years, what is the loss per share? They are straight away giving the value. But if they will give in the exam, you can't say, sir, you have not taught this. They will give you. After 3 years, the share price is expected to be 30, 40, 50. After 3 years, we are going to give them the shares at 40% price. So you will find out the difference. What is the loss per share to the company? The fair value of a share option means loss to the company per share. Whatever going to be the price of shares and what we are going to collect from them, the difference is called loss per share. That is called fair value of the option. Fair value of the option means loss per share to the company. Loss per share to the company is not written in the question, never. You need to understand this. If you don't understand, then in that case you will be feeling not happy. Discomfort. अच्छा नहीं लग रहा है. To make it happy, understand language of me. They will never say generally price is this price you will get difference. सीधा सीधी दिया रहेगा. Per share the loss to the company will be $10. Per share the loss to the company will be $10. By 31st December 2015, first year, January 15 to December 15, 20 staff had left the entity. 20 staff left the entity. In first year, out of 320 gone. And it was estimated that another 40 would leave before the vesting date. Vesting date means 31st December 2017. Because that is the date, those who will be there out of this 300, we will be giving them shares. So they are saying that first year already 20 gone and in next 2 years 40 will further leave. So ultimately we are not going to give this 20 and 40, 60 employees any share. We are going to give shares how many? 300 minus 60. That is 240 employees only. Then they are saying a further 15 employees left in 2016. 1 year further over. Now in the second year 15 also left. So in the first year 10 left. Sorry, in first year 20 left. And in the second year actually 15 left. Okay? And we are estimating in next 1 year 20 will further leave. Earlier we thought that 40 will leave in next 2 years. Now 2 years are over, further in next 1 year 20 will leave. And then in 2017, 18 further left. Now there is no estimation required, all is finished. In 3 years, how many left? That is actually we know. In practical life also you will come to know exactly how many left. Calculate the expense to be charged in the statement of profit or loss for each of the 3 years, 2015, 16, 17. How much expense we will be recording in profit and loss account every year for 3 years. Why we will be recording expense? Accrual concept. The expenditures and incomes are not recorded in books on payment and receipt. They are recorded on accrual. When 1 year over, for the 1 year, whatever the expense based on estimation, we need to record. When second year over, we need to record the second year expenditure. We can't say that we will see after 3 years how many will be there and we will. You can't do like that. Because then the pure accounting, not IFRS 2, it's pure accounting concept which I was discussing, accrual concept in the last class fully gone. We need to record income and expenses based on accrual concept. Now, when we are standing at December 15, we don't know what will exactly happen in 16 and 17. So when you are standing here, this much information is relevant. Don't think about actual outcome in 16 and 17. So when you are standing in December 15 in practical life, what you will do? Nobody will give you the figures. In practical life, either you, based on your past employee nature, You will forecast how many employee is going to leave in next 2 years. How many has already left in first year? That too you know. How many will leave, you will forecast. If you can't do, you need to take a help of some professional who can tell you that how many can leave the organization. But you need to forecast, because estimation cannot be illogical. Estimation has to be logical, then only the books of accounts figures are logical. Otherwise, the purely illogical we are doing. So we can see that they are saying 20 plus 40, 60 gone. Out of 300, 240 employee will be getting share. Per employee 1000 shares. So 240 into 1000, 2,40,000 shares. And per share the loss to the company $10. Because the price at which we are going to give them shares and the price in the market, the difference between them is $10 fair value of the option. So what is the total loss the company is going to suffer? 240 employee, per employee 1000 and per share $10. So 240 into 1000 into 10. That is coming 24 lakh. But this is not the expense or loss for 15. It is entire 3-year expense. You are standing at first year, but you are calculating entire 3-year loss based on whatever information you have. So the current year expense, that is 2015 expense, 24 lakh divided by 3 into 1 third. 1 year in place of 3-year total expense. So 24 lakh into 1 third is 8 lakh. The first year expense is 8 lakh. First year expense recorded. What will be recording done? Coming. First year expense 8 lakh recorded based on whatever estimation we have. Now the second year we are standing. At the end of second year, 20 and 15, 35 gone. At the end of second year, 20 last year, 15 this year, actually 35 gone. And at the end of second year, 20 will further leave in next 1 year. So how many employees are going to take the shares? 300 minus 20 minus 15 minus 20. 300 minus 35 actually gone, and minus 20 we are expecting. So 300 minus 55. That is coming 245 employee. Per employee 1000 shares. So 245 into 1000, 2,45. And per share $10. So 2,45 into 10, 24,50,000. This 24,50,000 is a new estimate for 3 years based on second year information. And the 24 lakh was the expense for 3 years based on first year expectation. This 24 lakh was also the 3-year expense, and this 24 lakh 50 also is the 3-year expense. But on the basis of further development, the estimation had changed. Earlier it was estimating 2 years, now it is estimating just 1 more year. So you are more sure relating to outcome. So the values have changed. But last year you have recorded expense already, 24 lakh divided by 3 into 1. Now this year what will be the expense? At the end of second year, out of 3 years, 2 years gone. At the end of second year, out of 3 years, 2 years gone. So what is the total expense of 2 years? 24 lakh 50 divided by 3, the whole thing into 2. 24 lakh 50 divided by 3, the whole thing into 2. I am not asking any figure, whatever will come. Suppose it is coming 15 lakh. Suppose the 15 lakh is the expense for first year, second year both. But out of 15 lakh, first year 8 lakh expense already recorded. So only second year expense 15 minus 8, 7 lakh. You need to calculate based on the revised estimate again the total expense at the end of second year. So what is the total cumulative expense for 2 years based on the new estimate? Out of that cumulative expense, whatever you have recorded in the first year, the balance is the expense for the second year. Now you are at the end of third year. Now to Jhamela finish. Now to all actual fact you know. 20, 15, 18. In 3 years, 20, 15, 18. 53 employees gone. So 300 minus 53, 247 employee. 247 into 1000 into 10. the total expense of 3 years again. But whatever you have recorded in last 2 years, that's already done. So what is the balance expenditure for third year? Every year you need to calculate a new figure based on the new estimate. On 31st December 2015, 300 employees, 20 left, 40 will leave in next 2 years. Per employee 1000 share, per share 10. Out of 3 year, 1 year gone, 8 lakh expense. Forget about journal entry for the time being. Then second year, out of 300, first year 20 gone, second year 15 gone, third year 20 will leave. Per employee 1000 share into 10, out of 3 year, 2 year gone, total expense of 2 years. Out of this 8 lakh recorded in first year, second year this. Forget about journal entry. Third year, all these 3 employee in 3 year gone, balance 1000. Per employee 10, 24, 70. Out of this, how much we have recorded in last 2 years? 1633. So balance is the expense for third year. We are saying that every year, based on the revised knowledge, we will be updating our calculation. Somebody will say that, sir, it is logical. It is 5000% logical. First of all, one logic. We need to prepare books of accounts based on accrual concept. When in 2015 we have already said that after 3 years we will be giving you shares at less than market price, then we know that there will be loss in 3 years. So every year we need to record the expense. But then the expense amount we don't know. The expense amount we need to estimate. Logical estimate. Relevant estimate, not illogical. These data which is given 20 employee will leave, obviously as per my understanding, company must have realized in the past, every year approximately 20 employees are leaving. So they are forecasting this year also 20. Where they are wrong? Nothing. You don't need to hire any specialist consultant to estimate what will be the employee who will be leaving. You can do that, man. Whatever happened in 2-3 years in the past, the same thing will happen. So in that case, we need to forecast every year a different amount. We are not changing 1000 share per employee. That is fixed. We are not changing $10. You will say that, sir, $10 will also change, na? Because when 1st January 2015, you are forecasting after 3 years, what is going to be the price, what price you will charge from them, then the difference is loss. After 1 year, the forecast about price will change. The problem is that when this is also allowed, then the organizations in the world will be doing window dressing. Sometimes they will say lower value, then they will say very high value. Then actually you are not purely following accrual concept. So the accounting body said that, we understand that 10 is not going to be the loss. The actual loss will be different. We understand. But we can't prepare the books like that, very haphazard. When you are announcing the scheme, at that time only you estimate what is going to be the loss. Now those who studied finance, in the finance for valuation of the option, there are 2 models. One is Black-Scholes option pricing model, BSOP model, and one is binomial model. Now I am not teaching that here. You will say why? Because it is totally different area, sir. उसके लिए खाली वो नहीं, बहुत कुछ बताना होगा. Many things. So that is not our cup of tea. But then this valuation can be done, IFRS has written, by the recognized model. Black-Scholes option pricing model or binomial model. Black-Scholes option pricing model is very famous. So you can calculate $10 based on that. Or maybe you apply your own understanding. This is going to be the price. This price I am going to offer. So balance will be the loss. लेकिन वो एक ही बार निकालना है. When you are announcing the scheme, that is on the grant date, that is on 1st January 2015. No further changes in that is allowed relating to price. Number of employee, then you can say, or any other non-market condition. Non-market condition means not relating to the price of shares. Other than that, whatever are there, we need to incorporate. Suppose here it is saying 3 years employment. Suppose it is saying that the company's sales revenue should be growing up by 50%. At the end of first year, we are thinking it will grow. At the end of second year, it will not grow. That is also non-market. Non-market means not relating to share price estimation. Share price estimation will be done only at the beginning, on the grant date. That will not change. But other conditions which are said as non-market conditions will be incorporated in estimating this value. Now, at the end of third year, we are going to give them shares. But not everybody who will take. Why anybody will not take? Because maybe they are thinking prices will be down further. We can't force them. So 300 minus 53, 247 are eligible. But only 225 employees are taking shares. Balance are not taking. Those who are taking shares, they will give money. So company will receive money, cash will increase. And the company will be giving them the shares. So 225 shares face value, share capital will increase. Relating to these 225 employee, 225 into 1000 into 10, you have recorded under equity, other components of equity that you cancel. And you record in share capital and share premium. So once you give them shares, other components of equity gone, money received, and share capital, share premium comes. And what will happen to the balance? 247 minus 225, 22 employees. They are not taking shares. We can't force them. Relating to that, we have recorded equity, 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 other components of equity 3 times at the rate of $10. Now that is not required. Equity gone. Equity gone. And that is added in the retained earnings. Matlab, this also will be coming where? This also will be coming under statement of changes in equity. Under statement of changes in equity, you will reduce other components of equity and you will increase retained earnings. Under other, this is one example. This is revaluation. Maybe here there is a column other components of equity. From other components of equity, the 18 employees, 225 minus 247, 22 employees. So 22 into 1000 into 10, the value which is there in other components of equity cancelled and which is taken to retained earning. You will say why? Earlier you have recorded 3-year an expense. And when you recorded the expense, the profit gone down, the retained earning gone down. But that is actually not an expense. They are not taking shares. So since that is not an expense, again you are increasing your retained earning, but that cannot be recorded in PL account. Because this is not an income for the current year. This is income of all 3 years. This is not the income of the current year. So this is not recorded in PL account. This will be adjusted in a statement of changes in equity only. One reserve gone, other reserve up. Somebody was asking reserves and surplus. Other components of equity is reserves and surplus. Retained earning is reserve surplus. Other components of equity gone, retained earning gone up. Those who are not taking shares. And for every 3 years, when you are recording the expense, then in the PL account, if they are working under factory, manufacturing, you will record every year expense in cost of sale or wherever. So every year the profit is going down, profit after tax, that is added to retained earning. The retained earning is down. And every year you are recording in the balance sheet equity, here other component of equity. At the end, when they are taking shares, the other components of equity become share capital, share premium. When they are not taking shares, the other components of equity is transferred to retained earnings. When they are taking the shares, then the share capital and share premium. When they are not taking the shares, then in that case it is other components of equity gone and retained earning up. Now generally in exams, they can't give, I will not say, but generally in exams, this portion they don't ask. I don't understand why. Maybe they are thinking it is simple, they are not asking. Ki bhai jisko share diye, those who are getting shares, you are getting money. For that you have recorded other components of equity, cancel. And share capital, share premium, recorded. For those who are not taking shares, other components of equity cancel. Credit in retained earnings. In retained earning increases. According to them, maybe this is silly. According to them, only this part is tricky. recording the expense every year with a proper calculations? Maybe. For that reason, they are giving the questions like this only. Now, just a theoretical concept which is applied in this example. The IFRS is saying that, IFRS 2 share-based payments, saying that the valuation for every year incorporates two types of changes. Used to pay, used to employees. Used to pay suppliers, used to pay employees. For suppliers, you are giving them the shares now only, that is earlier example. For employee, you are going to give them the shares after 2-3 years when they will fulfilling the conditions. For employee, we say that the grant date is the date when we announce the scheme to our employees. That is in the example 1st January 2015. The employee will be getting shares when they will stay in the organization for 3 years. That is called vesting condition, vesting period. The condition is 3-year employment and the period is 3 years. If there are no vesting condition attached to the share-based payment, it is accounted for full like suppliers. If the vesting conditions are there which are going to be fulfilled during that period, then it is called vesting period. If there are vesting condition attached to the share base, the entity should account for during the vesting period. The vesting period is the period over which the employee need to fulfill the condition. So in that example, grant date was 1st January 15. Vesting period is 3 years. 1st January 15 to 31st December 17. 3 years is the vesting period. Vesting date is December 17. And after December 17, maybe 1 month, 2 months, 3 months, they can take shares. So when they will be taking shares, that is called exercise date. I have given in the example on my own 225 are going for shares, that's other thing. The expense recognized every year in the PL account and other components of equity. And when the vesting period is over, when they are taking shares, then we will be giving them the shares, cancelling the other components of equity. And those who are not taking shares, recording that under retained earnings. If you go for the journal entry, when you are recording expense every year, then the expense debit all expenditure debited. Credit you are not paying now, you will give them after 3 years. So credit liability, but you are going to give them shares, not money. So credit other components of equity or equity. Later on, every time you are doing expense to equity, expense, credit equity, expense, credit equity 3 times. So after 3 years, total equity credit balance is there. Now against that, if you are giving them the shares, equity cancel, credit share capital, share premium. Against them, they are not taking shares, debit equity, credit retained earnings. Because it was deducted from retained earnings, from profit. Now it is again added to retained earnings, but not in PL account. This is not in PL account. This is straight away in a statement of changes in equity from one reserve to another reserve. When they ask questions, they ask up till here only. They don't ask. If they ask, doesn't matter, they can ask. But generally they don't ask whether the employees are taking shares, how many of them are taking shares. They just ask, what is the expense every year? That only they ask. So that is, you can say, covered in the example. But my purpose of covering the example is only one thing. That covering the technical language, doing some calculation based on an example, the accounting treatment of that example in the balance sheet, which assets, which liability, whether equity go up, go down, where it will be recorded in the PL account, or maybe for somebody, those who want to follow the old concept, debit credit journal, they can follow the journal concept also. Just give me 5-6 minutes more, then you all for the time being can start asking questions. Just give me 5-7 minutes more. This is what the cash settled. Cash settled means at the end of 3 years, if the same example, we are not going to give them shares. We are going to give them cash. Now there is no option. Nobody will say that I will not take cash. Nobody is a Kalidas. That is cash settled or stock appreciation rights. That is termed as like this. Under this, we will not be recording equity because we are not going to give them shares. We will be recording liability. And the liability will be coming under non-current liability. Under this, the example, it's same example, just slight 5% changes. On 1st January 2014, an entity granted 20 employees 50,000 share appreciation rights. On 1st January 2014, an entity granted 20 employees 50,000 share appreciation rights. They are not saying 50,000 per employee. In total for 20 employees, 50,000 share appreciation rights. That means on 50,000 cash will be given to 20 employees. Per employee 50,000 by 20. That they are directly giving here. To be entitled to the bonus, the individual must still employed on December. January to December 2014 1 year and January to December 15 2 year. Only 2 year. 2 years काम करो 2 साल बाद पैसे लेकर जाओ. In the year ended December 14, first year end. No employees left. पैसा बहुत प्यारा है. They not a single employee is leaving. But one was expected to leave prior to vesting date. First year nobody left. But second year one is expected to leave. एक छोड़ने वाला है. In the second year end, when the scheme is over, 3 left. अब 3 छोड़ के चले गए. ठीक है भाई. The remaining employees are allowed to exercise their rights on December 16. After 15, within 1 year, they can exercise, not 1 year, 2 साल तक. They can take the cash in 2 years. 15 they are eligible, but 15 के बाद 16, 17 they can take cash. ऐसा होता है, कितना भी साल दे सकते हैं, हमारी मर्जी. 7 employees exercise their rights in December 16, and at that time the value was 37. And then the following information is available. At the end of first year, the value of cash loss is 27. On second year, 35. On third year, 40. And then calculate the expense for each year. For 2 years basically. Now for the time being, assume that this is not cash settled. Assume that we are not going to give them cash. Assume that we are going to give them shares only. Okay? Just for assumption. And when we announce the scheme, at that time, suppose the value is 27. Like in the last example, it was $10. When we announce the scheme on 1st January 14, the value per share is $10. The value per share is $10. Like this, the value per share 27. So if I will solve this same example based on the last example, same, then we are saying that 50,000 shares. In the first year, 1 employee left. No, nothing left, but 1 is going to leave. So what is the average number of employee left? 19. For 19 employee, it is 50,000. Sorry, for 20 employee, it is 50,000. For 19 employee, how much? We can calculate. And then per share, the loss is 27. But then the loss is not of first year, first, second year both. We are estimating the loss at the end of first year for 2 years. So what is the first year expense? Divided by 2 into 1, we will record in the first year. Second year they are saying that 3 employee left. So 17 will be getting. For 20 employee, 50,000 shares. So for 17 employees, how many shares? Per share, 27, the same value. So the total loss in 2 years we are getting. Minus the first year loss we have recorded. The balance loss is of the second year. That is as per the previous example, which is share-based payment ESOP. But this will be not like that. When we are going to give them cash, not shares, we are going to give them cash, then the accounting says that at the end of every year you need to incorporate what is going to be the price, what is going to be the loss per share. Somebody will say that, sir, here the window dressing will not be done. Here not recording the actual cost will be window dressing. When the share price at the end of 1 year was 27 expected, and now it is 35, now 40. How can you record in the second year 27 only, when you need to give them $35? So here not recording cash on appropriate value will be a window dressing. So when it is cash settled at the end of every year, market conditions will be used to forecast what is the cash payment. New forecast. In case of equity settled, no new forecast. But in case of cash settled, new forecast. So here the first year expense will be how much? Here the first year expense will be how much? 50,000 for 20 employees for 19 employees into 27. That will be the case. They have given 50,000. 1 second. Each, sorry. It is written each. Each means it is not for 20 employee. Per employee 50,000 shares. So 20 into 50,000, but out of 20, one employee gone. Gone means one, nobody left, but in next 1 year, one will leave. They have written. So 20 minus 1, 19. 19 into 50,000. And per share, it is $27. This is the loss for 2 years. So first year into 1 by 2. Recorded as expense, recorded as liability, not equity. Because you are going to give cash. Second year. Second year, 3 employee totally left in 2 years. So 17. 17 into 50,000 per employee and into 35. That is the total expense of 2 years. Whatever you have recorded in the first year minus. Balance is the expense for the second year. Again expense recorded liability because you are giving them the money. They can take the money in next 2 years. So at the end of second year, your liability is based on 35. Now in the third year, how many have taken the money? In the third year, by 2, 7 employees taken the money. Those 7 employees are taking money at the rate of 40. You have your opening balance 17 employee per employee 50,000 per share 35. But out of that 7 employee 50,000 per employee into 40 gone. Into 40 gone. How many money? How much? No, into 37 gone because those employee not taken on December 16. They have taken during the year any time. So at the rate of 37, we have paid the money. But then how many employees are still left? 17 minus 7, 10 left. For 10, what is the closing balance? 10 into 50,000 into 40. 10 into 50,000 into 40. That should be the closing balance which they can take in 2017. Opening balance at the rate of 35. Payment done 7 employee at the rate of 37. Closing balance would be at the rate of 40. Whatever is the difference, that is the expense in the third year. And then whatever will be paid in the fourth year, further expense will be coming. For first year, 20 minus 1, nothing has left. 1 is going to leave in next 1 year. 19 per employee 50,000 into 27, half. Profit and loss, expense, debit, liability, credit. Second year, 3 gone, 17 left, into 35, this. Out of this first year expense recorded is 12.8, balance expense. Now, third year, this is the opening balance of the liability from the second year, 29.8. Out of that, 7 employees took the shares, took the money at the rate of 37. The 10 employees are left, this should be the balance. So this is the balancing figure. The expense for the third year, even though the scheme is for 2 years, but still there is an expense in third year. Why? Because this is cash settled, there we need to keep the balance based on the revised value. So because of that, there is an expense in the third year. Again in the fourth year, the information is not given. This is the balance. But suppose in the fourth year, the cash given as the rate of 42. When they took the cash, it is at the rate of 42. So further 10 into 50,000 into 2, we need to record expense in the fourth year. Even though the scheme is for 2 years, but we need to record expense in third and fourth year also. In cash settled, one change. The value of the option, the loss per share will be recalculated at the end of every year again. In the equity settled, that is not recalculated. That is based on the grant date value only. But in the cash settled, the revised fair value option calculation need to be done at the end of every year. Normally in the market, if I will say practically, this fair value calculation done by Black-Scholes model. If you know very well, if you don't know, you need to hire a consultant. He will do the valuation and he will give a certificate that this is the value of the option. Accordingly, the books of accounts are prepared. It cannot be you can say 40, 35, anything and public will accept, anybody will accept. The auditor will not sign the statement if it is haphazard. It has to be based on principles. The principles are Black-Scholes model, very famous. That valuation will be done based on financial concept. If you know, you apply. If you don't know, hire somebody, give them money, do the valuation and then record. Then the earlier doubt in the class today, he was saying that what is the principle for recording the liability? This is what liability only. Equity, non-current liability is liability only. Assets and liability, every IFRS saying what will be the value. There is no common sense historical principle or this, that. No. Every IFRS based on some assets or some liability information. So every IFRS, when you understand, you will understand the valuation of assets and liability automatically. That will be discussed in every class. Cannot be discussed in one day. Now somebody will say that, sir, if I don't remember in exam, this is IFRS 2. No problem. If you write correct number only. Don't write wrong. Are there 5,000 IFRS? No. Around 25-30 IFRS are there. Maybe around 35. ध्यान दीजिए पढ़ने के टाइम पे you remember correct numbers. If in the exam you don't remember, you write as per IFRS. That's all. Don't need to write IFRS 2 share-based payments. याद है तो लिखिए. We are saying that under cash settled, non-market, market, both need to be incorporated. But under equity settled, non-market only. Market, no. The prices are changing? No. Just at the grant date. So here it is a liability because cash will be paid, and there it is an equity because shares will be given. Here when you give shares, liability cancel, cash gone. But there if you give shares, equity cancel, share capital, share premium. There if somebody is not taking equity, retained earning transfer. Here nobody will not take. Nobody is bewkuf. Everybody has some brain. Why they will not take money? Why they are taking late? Because when they are doing late, they are getting more and more money. Sabr ka phal meeta hota hai. When you were taking money in 2016, you were getting 37. When you were taking in 2017, you will be getting greater than 40. तो वही रुकिए. लेकिन पैसा सब लोग लेगा. Nobody will say that I will not take money. So cash settled, there is nothing balance left transfer to retained earnings. But in case of equity settled, balance will always be there. There are many who will not take shares. So unka balance we need to transfer from equity to retained earnings in statement of changes in equity. So under cash settled, market conditions are incorporated. Recalculation of fair value at the end of every year is a must. But under equity settled, market factors are not taken into consideration. The fair value will be calculated only once at the grant date. उसके बाद उसको नहीं निकाला जाता. Because वहां window dressing will be there when you recalculate again. It is already not cash to be given. Here window dressing will be there if you don't recalculate. You are recording the non-current liability wrong figures. You are doing window dressing. You are not showing the correct liability. When it is 35 or 40, you are still recording 27. But there तो you need to give shares. पैसा तो वैसे भी नहीं देना है. Money तो we are going to get, shares का value बाद में ही adjust कर देंगे. Why we need to incorporate fair valuation? There is, according to me, one more principle under equity settled. If you want to calculate Black-Scholes model fair value again and again, there is an additional time, pressure, expenditure to pay to the consultant. Why to waste money? The accounts will never be asking you to do something which is just a waste of money. So for that reason, under equity settled, the fair valuation calculation not done again, just once at the grant date. But in the cash settled, the fair valuation need to be done again and again. Maybe it is expensive, but it has to be done. No other option. Because otherwise the correct amount of liability you are not showing. And that is a major issue that I think if somebody remember Enron or any company case, any default arises in the past, they have not recorded their liability properly. So one, it is payable in cash, it has to be recorded at the fair value at the end of the year. But more or less both the story are same. Now in both the stories some adjustments are there, which I have not yet discussed. In between there are some examples. But basic understanding what is share-based payment. 2 suppliers, very simple, not going to come. 2 employees, whether it is equity or cash settled, that we have discussed. There are so many examples in different books. Maybe you will open. Now these are the materials which are there in the drive, which I have shared with all of you. अगर आप इसको खोलेंगे ये सारा मटेरियल यहां पर है. I have downloaded this. You also download the material from the Google Drive. Save in a folder that again and again you don't need to open the drive. You all can download. I have given again in the class. And then suppose somebody want to use, suppose BPR, BPP, Diploma IFRS Kit. Diploma IFRS Kit. Suppose you want to use that. Okay. Suppose this is opened. This is Diploma IFRS, all the past term exam questions. Just that when you use this, don't take printout. Don't write your answers in pen and paper. Please, request. Study on screen. When you need to write an answer, open a Word file, type there. Open an Excel file, do the calculation there. That's advisable. I will be doing in the class. Abhi I have not taught anything. How I will do? I will be doing. But don't take printout even though you are getting the opportunity. Because the failure happens for 2 reasons. Either the concept is not there, nothing can be done. Concept is there, but the speed is not there. You are following the same old drawn principle. Pen, paper, this, that, underline. You cannot pass the exam like that. So here, you go into the index. In the index, revision exam questions. Where is the index for the topic? Just 1 second. Just 1 second. What are the topics? Yes. Accounting for associates. Suppose employee financial instrument, share based payments. You see, first of all, December 20, September 20, December 19, you will say, how come September 20? Corona time. In the Corona, there was no exam in June. So they took extra exam in September. Normally the exam are December and June. December, June, December, June, December, June, December, June, December, June. You will say that, sir, this is up till December 20 only. ए भाई मैंने पिछले दिन दिखाया था फर्स्ट क्लास ऑलरेडी इंस्टीट्यूट वेबसाइट आई एम नॉट गोइंग अगेन यू गो देयर आई हैव सोन ऑल द पास्ट टर्म पेपर्स दे आर देयर ठीक है सो आई मीन टू से दैट इफ यू सी दीज 1 2 3 4 5 6 7 8 9 10 11 12 टर्म्स इन 12 टर्म्स शेयर बेस्ड पेमेंट मोटा मोटी इन एवरी टर्म 1 2 3 out of 12 terms 3 term missing 9 terms the question came in exam. That means 75% frequency that the share based payment chapter questions will be coming in exam. No guarantee. But this data is saying that this is very high frequency that the questions will be coming in exam on share based payment basis. ठीक है ना? Now, small and medium sized related party earnings per share presentation, share based payment. There is a question 32 number, there is 33 number, there is, no, this is numbers. 1 second. What is the heading given? This is marks, time allocation, page number, question, answer. This is the page number in which you will be getting the question. And this is the page number where you will be getting the answer. So this is, you can say, कहाँ गया? Share based payments. Share based payment, you will get a question in 37 number page and the answer in 137. You will get a question in 38 number page and answer in 139. It's not that you need to solve all. But if you want to practice extra questions, suppose 38 number page. Now I am putting 38 number page. ठीक है? 38 number page means this 38, this is 20. So 38 means you need to take around 56. 56 means it is 38 number page, you see. And in this page, either this question or this question are employee fair value of one right and all that. Share based payment question. Suppose you don't want to do the questions from here, because I generally like to solve the questions from SBR study text. SBR study text. This is another book. You should not be doing questions from all the books, not a mad. From any book, 1 or 2 questions we should try. But which book? You need to select. I will select this book because this is much better way explanations are written. That book I generally don't like. This is share-based payments. Share-based payment, 213 page number. So say around 240 page number. 240 share-based payment. Share-based payment. This is the chapter starting. 237 page number. In this here the explanations are written, and in between there is test your understanding 1, 2 like this. Test your understanding 1. Test your understanding 2. The answers are written at the end of the chapter. Suppose the chapter is of 15 pages. So go in 260 page. No. This is going into next chapter. So you can see at the end of the chapter the answers are there. At the end of the chapter the answers are there. This is test your understanding, first one question answer. But then what happens? The student read the question and they read the answers. They think that it's done. That's the worst study. If you do the study reading the question, reading the answer, don't study, better. When you do questions from here, what is the first thing you should be doing? Which I said in the previous class. First do the recording again. Maybe you are a champion. You understood everything. But still, at a fast pace, do the recording again. First thing, do the recording again. Second thing, whatever is discussed in the class, do in writing again. Writing matlab not pen and paper. On a Word file, solve these 2 questions again, which I discussed in the class. When you will be solving on your own, even though after recording, many of you find that you are not able to solve. You are doing mistake. Solve it. Do it mistake. Do wrong. Then see the solution again. Make yourself ready. Make some notes. Then go here to solve other question. Otherwise not. Otherwise, you will be demotivating yourself, not me. Because when you open this question, you are not able to solve. You will think that why? Because you are not giving proper time to understanding. If you don't understand in any book, you can't solve any question. If somebody wants to solve any question from any part of the world, CA final book, CME India final book, Pakistan CA book, wherever you want, any Google, whatever, I don't have any problem. Why I am so confident? Reason I know, I understand. I know the concept. So there is no problem when the question will come from anywhere. So don't try to solve questions from all the books, from BPP, from Deep IFRS, from study. I have given that much, nobody can solve that much, not required also. But you go on asking, sir, BPP मिलेगा, Kaplan मिलेगा, भाई सब मिलेगा, सब दे दिया आपको. All books I have given, there is no other books in the market. But as I said, the most important book is this book, which I am writing, with the synopsis, with referring every books, doing an analysis, understanding what I have given in the last batch, what example I need to see, separate, what is the technical outcome given on the institute website, सब कुछ देख रहा हूं मैं. तो आपको ये सबसे ज्यादा काम आएगा. फिर भी, your concern, you can use any book, any material, I don't have a problem. All the materials and everything given to all of you. And whatever is written here, I am sharing after the class, mailing after the class to all of you. You don't have to request. If you follow my principle in 1 or 2 class, maybe you are a below average student, you will feel confident. But if you don't follow, you follow your strategy, not doing the recordings, not solving the question again, which is discussed, and straight away doing the new questions, nothing will happen. You will just demotivate yourself. That I know, my 30 years experience, that I am sharing with all of you. So now for the time being, any doubt anybody has, you can raise your doubt next class also. For the time being, I am saying, any doubt, whatever we discussed up till now, Mr. Adnan, Mr. Chindarkar, Anjali Bansal, Anup Kunat, Anuradha Dumpala, or anybody here, whoever is there. क्या भाई? हिंदी इंग्लिश पर्सन, सर स्पीक इन इंग्लिश और हिंदी. So we are leaving for today. Next week, Saturday, we will complete this. It will take around 2 hours further. And we will start with the new topic, employee benefits also. That is also related with employee. Fair value is intrinsic value. The another name for fair value. Like I have written in the question fair value of the option. You can say intrinsic value of the option. एक ही बात है. Obviously, yes, my responsibility, liability to mail just in 5 minutes after the class. Okay? So leaving for today. Enjoy your weekend. Study hard. Thanks a lot. Take care, everybody. Okay?